So before you buy a business or invest into a stock, which is equivalent to buying a business, because basically you're becoming a shareholder in that particular company, you really want to understand three basic components of that particular company. So today I want to talk about how to become a smart investor. Now, we all make money, we all save money, but somewhere deep down in our heart, we want that money to grow. And therefore, we invest, we buy lands, we buy business, or we invest in stock market or bond market, or keep it in your savings account in your bank. Because ultimately, you want your money to grow. You are hopeful that wherever you invest your money, you will get some handsome return on it. But how exactly will that return come? You have to know. A lot of people make a lot of money by speculating. When I say speculating is when you hear it on news channels or from a friend or relatives that okay, certain stock is gonna go up. You put money into it and definitely it goes up and you make good profit on it. That is called speculating because you don't know about it. You just heard somebody else tell you that. If that stock were to go down, you would have absolutely no idea why it went down. Or when that stock is going up, you have exactly no idea how you're making profits on it. You're just speculating. And you might make money by speculation once, twice, or in a shorter term. But you have to become a smart investor. You have to know what's happening in that company and outside of that company, at a world level, at a country level, and at a company level. What is happening in order to become a smart investor, in order to make money on a long term. And that is eventually our goal because you don't want to bet your hard-earned money on speculation because that will not always be profitable for you. So let's talk about three main components that I really want you to understand before you put your money anywhere, in any stock, in any business. These three applications will always apply. Alright, so the first one I want to talk about is accounting. Knowing accounting means having financial literacy. Knowing accounting means being able to read numbers, understand them, and it should make sense to you, just like words do. It should talk to you. Once you learn the accounting, when those numbers start talking to you, when you see the balance sheet, when you see the income statement, or when you see the cash flow statement, you understand, okay, this is what the company's assets are. This is how much company has it in liabilities. This is how much money is coming in, and this is how much money is going out. You will be able to evaluate the strength and weaknesses of that company. You will be able to evaluate the strength and weaknesses of your own. You will be able to manage your spending. You will be able to consider your risk. You will be able to manage and evaluate how much risk you are taking on that particular investment. And that is very important because you want to know when you're putting your money into it, you want to know how much risk you're taking on that investment. From the risk level, you will be able to understand how much money you want to put into it. If there is no risk or low risk, you'll put more money into it. But if it's a high risk and high return, you'll put considerable amount of risk. But to understand those stuff, you have to know the accounting part of this. Alright, so now you know what I mean by accounting. So the second component that I want to talk about is investing. Now, what I really mean by investing is that the science and the strategy of your money making money for you. When you're investing your money into something, into let's say a stock, you are hopeful that the money that you have put down in buying those stocks will generate you more profit, will earn you some dividends, or the stock price will go up. As a result, you will make more money. What I mean by investing is knowing whether that company has futuristic goals, whether that company has futuristic vision. When you are buying a business, let's say a small business for your own, a restaurant or something, you're evaluating that business that business's demand will go up. You're evaluating that the customer flow will increase. Only then you are going to buy into that business. Same applies to stock. You have to understand whether that company has futuristic vision, with whether that company has futuristic goals. You don't want to invest into something that's going to be obsolete in very near future. A friend of mine invested into BlackBerry in 2009, because back then, if you remember, BlackBerry was really famous among the youngsters, because everybody in high school and college, everybody was using BlackBerry because it was so easy to type and everything. It was the futuristic phone, but it did not last 2 years. Android, Samsung, and Apple took over it. All of our first phones, if you remember, what phone did you buy, the very first one? It could be either Nokia, BlackBerry, or Motorola. All of them are obsolete. People who invested into their stocks have lost so much money into it. So you have to understand whether the company has futuristic goals, whether the company has enough plans to beat their competitors. Let me give you an example. In 2019, Air Canada announced that it was going to expand its services to 29 new locations and 23 other countries. And after that announcement, the stock price of Air Canada went from $30 to $56 within the next 6 months. Why did that happen? That's almost like 100% bump. $30 to 56, that's like 100% gain for Air Canada just in 6 months. Well, it happened because people believed in their futuristic goals. People were able to connect with their financial and futuristic vision. They had a goal that we are going to expand our services to 23 new countries, 23 new locations. People believed in their vision. And you have to believe, as an investor, you have to believe in whatever the company you are buying or investing into. You have to believe into their vision. And if you can connect it, if you can understand, if their vision is making sense to you, then only you put your money into it. If you don't stay away from it. There is so many opportunities will come and will go. You have to wait for the right one. You can't just put your money into anything, because eventually you will face a very big loss into it. So that's what I mean by investing. You have to understand how your money will make you more money. And by what I mean by that is you have to understand what are the company's goals, how that company is going to make you future profits. And you have to understand that before investing into any company or buying any business. Alright, so now we have covered two components that I wanted to talk about is accounting, knowing the financial side of the company, for example, learning about balance sheets, income statement and all that. So you know what the cash flow is like, you know how much assets and liability it has. And then the second component I talked about is investing. Knowing how putting money into that business will make you money. Knowing about their goals. Now the third component that I want to talk about is understanding the market. What I mean by understanding the market is that you have to know what's happening outside of that company, because the first two components that I spoke about is what's happening within the company, what are the company's goals. But the third one is about what's happening outside the outside that particular industry or outside that particular company. You have to know what's happening in macroeconomics. What is macroeconomics? It's the economics at the world level, or it's the economic at the country level. Understanding macroeconomics is like understanding the supply and demand of the country. Understanding whether the country is in recession, whether it's in the bull market or bear market. Bull market is when the stock prices are going up. Bear market is when the stock market is going down. So you have to know all this stuff, because eventually everything has an effect to your business, to your company that you have invested into. Everything has an effect. You have to know the supply and demand in the country. If you figure that the demand will increase in future, the price of the company that you have invested into will also increase. If you figure that the demand will decrease, the price will decrease. Right now, for example, let me talk about this example. I'll give you an example so you understand more. Let's talk about this company, Johnson & Johnson's.
Okay, so as you can see, in last 1 month, Johnson & Johnson's is on rising curve. It did fell quite heavily in the beginning. While all other companies are still trading at low prices, Johnson & Johnson's caught up on their stock value. There has not been any major changes to their cash flow or company's management. But the reason the prices are rising is because Johnson & Johnson is making a vaccine for the coronavirus. Now, even if they get success into making that vaccine for the virus, the company won't be directly making profit on it until at least next 2 years. Yet the prices are already going up. This tells us the investors are anticipating the success of the company. They are anticipating that if the Johnson & Johnson's do end up making an effective vaccine, the company will be valued more. So just by the news of the company making vaccine, the value of the company is already increasing. That's what I mean by understanding the market. When you know what's happening outside, you will understand why the prices are rising or why the prices are falling.